Morning, Peter Rose, Longwood Currency Trading. Today's topic, or this morning's topic, I may have a topic later this afternoon, who knows, in this early February 2021 cold winter day, our topic is, do you let the dog run or not? Do you let him out to run or not? It's sort of an allegory to the decision of taking a trade with the long-term up, but counter to the shorter-term trade price action that's short. I think this is only going to be of interest to you if you're either a swing or a day trader. I think if you're a long-term trader trading off the dailies or the weeklies or even up on a 4-hour, this probably won't resonate with you at all. So with a cup of coffee, whatever brought this on? Well, the last couple of videos that I've done have been, and none of my videos are interrelated such they work as series, so they can be taken independently. But the discussion that I've been having was with an anomaly in my own trading process that I discovered, where I would tend to trade against the longer term time frame, even though I knew that that was the long bias, because my trading time horizon is a couple hours, and so I make my immediate trend bias based on the 15-minute chart and then trade off of the 5. And I get away with that pretty well, except a few times, too many times, I get caught and the price runs against me, and I have such a short bias. Let's just say I'm trading short. The daily chart is up and the 15-minute is down, and so I have this short bias to my particular trading day, and the price goes against me, and I start going, well, it's a excuse me, it's a normal reaction, and all that sort of stuff. And the more it goes against me, the more I have a tendency then to look up on maybe the hourly chart and say, well, price is about to bounce off of this 55 period moving average or 21 period moving average, and then it should continue down. Okay, well, there's been a kind of an analysis of that whole, a reanalysis of that whole situation based on my friend Langer's, this Scruffy trader, being very adamant about, I mean, he trades down on the 15 and 5, and he just won't trade if the daily is up. He isn't going to take a short trade. If the daily is down, he isn't going to take a long trade. And yet I've had great success in doing counter trend stuff because my time frame is shorter that I'm looking at, where Langer's will go 4, 5, 6, 8 hours on a trade. It'll take one trade, whereas I'm more willing to get into a trade, have it go against me, get out, come back in, and ultimately complete the same cycle that probably he would, but it might take me 3 trades to do that. And every now and then I get caught, and he doesn't. And so I have to balance his advice with my personality, which is, I don't want to sit there for 6 hours or 8 hours. And I don't think the majority of the traders out there that have a personality that wants to see action, that wants to see price movement. You want to look at the chart. There's either an opportunity to trade or there isn't. And if there isn't, go get a cup of coffee or go to work or whatever you're going to do. If there is an opportunity to trade for an hour or two, close it up, go flat, and go to work. Or trade off for the daily closes or the 4-hour closes and be at work and check in every 4 hours and make your trading decisions. I mean, there's a personality that fits with either one of those types of trading. And you can be successful doing either one. But you can't be successful mixing paradigms. And so this is the situation that I'm in, as I'm looking at my paradigm, and I found where the weakness was, and so I'm doing some experimentation with that and to try to bring some clarity to it. And I'm going to discuss that in this video so that you can work on it too or comment on it. Or if you're not interested in doing it because you're on the other side of the fence as to where I'm trying to figure out whether it's viable or not, you just ignore the whole thing. But I think it's an academic question that once you're into trading for a while, you really need to ask yourself. I think as a beginner trader, you don't have such questions. You have to be very dictatorial in the rules that you have. And I would agree 100% with Langers that if the long-term trend is up, you trade up. You don't, no matter what's going on in the lower time frames, you trade up. And if there isn't an opportunity to trade up, if your 15-minute trend is down and the daily trend is up, and the 15-minute trend keeps going and going, and you don't trade against that. You just don't. You might trade against the downward 15-minute by trading up off of a 5-minute chart that's bouncing off that 15-minute moving average. You might do something like that. But for the most part, a beginner shouldn't be complicating their trading. And I don't complicate my trading. The trading that I do is very simple. I'm in a situation where I've kind of peeled the onion back, and I see that there's something there that from a mathematical standpoint creates an anomaly in my thought process. It may turn out after I've done some research that I have some other ideas, and I'll certainly share those with you. There's some computer programming I'm going to do on it. I'm going to do some back testing and all that other sort of stuff. This is what we do as traders. That's what Jesse Livermore said. You invest your cash, track your results, and learn from your mistakes. And so that's what I'm doing, because I got caught in a really bad situation. I talked to Langers about it, and he said, "What are you doing? Why did you do that in the first place?" And I asked I stepped back from the thing in the manner that Langers said, and I said, "Why did I do that? I didn't have a good reason for it, and there were some price action anomalies that should have alerted me to not do that." You can still counter, I believe, counter trade that upward daily, but it's going to require a new rule, and I don't think it's a rule that you want to put into your trading or even a consideration. Again, if you're a beginner, don't fucking complicate it. Take the daily trend, and whatever direction that's going in, that's the direction you trade in. Just don't be stupid. But because your trade entry analysis will tell you whether you have a viable trade. I mean, the long-term trend up will reverse at some point. There'll be a swing or a spike or some shit that goes on, and all of a sudden the daily trend will go down. Now, that doesn't mean that it's going to get down 2,000 pips, but it could get down 300, 400, 500 without much problem. And with the currency pair that I'm trading right now has 120 pip ATR. So how many? 3 days you could have that reversal. 4 days, or if your candle expands to 180 pips, which we've certainly seen. Geez, you can get 120 pips on a 15-minute candle. So it doesn't take long for things to go wrong or to revert against where you're going. That's why I'm a big proponent of being down on the shorter time frames, because you get that right away. You find out that you're wrong right away when your time horizon is so much shorter. Well, how did I come to this Do you let the dog run or not? For a title for this video. As I said, the letting the dog run is an allegory for counter trending, trading counter to the longer term trade. And I kind of came to that because we're in New England here, and we've been getting winter storm warnings for the last few days. And later on today, you know, we're going to be in the mix on this stuff. And so the question, as my wife headed out the door today and said, "Don't forget to take Beau dog out for his business this afternoon." Well, we may be in the middle of a shitstorm this afternoon. So do you let the dog run, or do you not let the dog run? And by running, I mean, I'm probably going to go out with him, and we're going to walk in the woods behind the house so he can do his business and get his ass back in. But the storm's coming. There's a nor'easter coming, and they're predicting anywhere from 8 to 18 inches, and being on top of a small mountain up here, we're probably going to get hit with the 18-inch part. And so I don't want to be wandering around in the woods in a snowstorm at 2 inches an hour, because it's a slow-moving storm. So do you let the dog run or not? That's how my mind works. That's how I get screwed up sometimes. So that's the thrust of the video here. So I put my coffee down here and I can flap my arms a little bit, which you won't see because I'm going to put up a slide and talk through this a little bit. And you'll notice that the slide that I'm putting up, it's hand-drawn and it's crude. I don't like to put up chart because the tendency for you as an observer would be to look at that chart of real prices and get distracted by trying to say, well, this is the real deal, and he's talking about down here, but a similar situation is occurring up here, and blah, 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 blah. I avoid that by drawing caricatures of price action. If you've traded for any length of time, you can extrapolate and you can see this. If you're a beginner to trading, you won't like this, and it won't make any sense to you, and it'll confuse you. But I don't teach beginners, so sorry about that. Watch it and see what you can pick up. But as you'll notice from the diagram, I've got this long rising line, which is representative of the daily price chart. So that, for boys and girls, is a rising daily chart. And if you drew moving average lines under that, the 200 would be rising with that. I mean, that's the extent to where you want the trend to be, to say this is a really good, strong rising trend. And then below that, you see another trend that's a downtrend, and that's going to represent the 15-minute time frame. So you can see that, and it's not proportional, the 15-minute length is not proportional to the segment that 15 minutes is in that upper daily chart diagram. It's just representative of a 15-minute downtrending price action graph. And you notice I've got a couple of numbers there. Number one is about, a third of the way down that 15-minute dropping period, and the second one is all the way at the bottom of that 15-minute period. And so you've got, there's a dotted line that's above that, and let's just say that's the, maybe the 200 period on the 15-minute, or maybe it's the bottom of the 55 on the daily chart or something. I mean, you can figure out what those periods are transposed down onto lower time frames, and then, for example, a 55 period on a daily might be a 400 period on a 5-minute. I mean, I don't know what that would be, but you could do the calculations and put it right there on the 15-minute chart. But you can just take the current price and and look at that level up on the daily chart and see where that stands in relationship to the moving averages on that daily time frame. And so all I'm doing is saying that the distance 1 that price is from that point is going to be from that horizontal line in the squiggly bracket. That's the distance there. And then on number 2, you can see that that distance is far greater. If you've watched some of my previous videos, we talked about Hooke's law and regression to the mean, or what they call in finance mean regression. And so the fact that that moving average that you're looking at may be a moving average that belongs to the daily chart is immaterial, because you can still calculate that same period expanded out down on that 15 minute. Doesn't make any difference what it is, but there's a differential distance from the current price on the 15 minute to that moving average, whatever that is. And we saw that in regression to the mean analysis, that kind of gap between the current price and its associated moving average, whatever that is, could be an 8 period, could be a 200 period, I mean, any difference, but it has to be proportional, and that gets into areas of computation we don't need to do in this particular video. All we need to say is that the longer that 15-minute time period downtrend goes, the further the distance it is to that moving average, whatever it is, the one we're talking about. And so the tendency by natural law, by physical law, and the laws of physics and mathematics, and just psychology and trading, is you're going to have at some point a regression to the mean. And that 15-minute chart will start to turn up. And so the allegory of do you let the dog run or not is how long do you let that 15-minute chart go where it's safe to let the dog out, where it's safe to put a trade on, where you're not going to experience a regression to the mean event. And from some of the computer simulation stuff that I've done, and just some of the current backtesting and looking at these things that I've done with these different moving averages, when that 15-minute chart does its mean regression, it doesn't do it gradually. Many times you'll find that 15-minute chart do 200 pips in a couple of hours. It's like that spring. It becomes very violent. And so that's where I've been getting caught, is thinking that those regression points weren't necessarily regressions, but rather normal reversions to that 15-minute downtrend. So the position that I'm proposing that you guys look at and be aware of is that the further that 15-minute chart goes down in relationship to the upward daily chart, the more likely it is that you're going to get a reversion. And the further that 15-minute goes, the probability is that the reversion will be of a higher magnitude than a simple, I'm going to swing off a little bottom and I'm going to start a new trend, okay? Because you're reverting, your mean reversion isn't going to just to the downward moving average, the 55 period moving average on the 15-minute. It's really reverting to the 21 period or the 55 period on the daily chart. That's a big gap to cover. And so those price movements are going to have to be great. I mean, if you understand the laws of physics and how Hooke's law is structured, you can kind of work your way through and view this more from a mathematical standpoint than maybe someone who's not quite so versed. All right, so enough of that. Enough of that chart. Time for another sip of coffee, I think. So, number one, and again, this is only of interest to the swing and day traders. Because the longer term traders, you're not involved in any of that. I mean, what are you going to do? You're going to worry about what the monthly chart is doing in relationship to the 4 hour? I mean, that's crazy. You're not a trader then. Once you go above the daily chart and you're starting to look at the weekly, you're not a trader anymore. You're an investor. You're looking for holding that trade for a month or two. Even swing traders don't hold it that long as a trader. If you're doing long-term swings off of the weekly or the daily chart, your trade's going to run. It could run a month or 2 months. That's not trading. I mean, I was a real estate investor for 40 years. I held properties for 30 years. I wasn't a fucking trader. I was an investor. You know, a guy that flips a house. You can flip a house in 90 days. That's probably, you're a trader. Well, the term for real estate trader is a flipper, right? So let's not mix our paradigms here. The analysis that you want to do, if you are a swing or a day trader, is when or if it would be safe to counter trend. Now, there's two camps to that. One, which traders like Langers fall into, is they keep things really, really simple. If the day trend is up, regardless of what's going on in the 15-minute, they're only going to make long trades. And that makes a lot of sense because eventually, you don't know when that 15-minute is going to flip around. So why complicate your trading? But I've had great success doing that. What's great success? 15% a month for a long period. Now, it's small account and all that other stuff, and so people can argue with me. And it's also on the in simulated account, because I did all my original. That's how I got to be a day trader is by getting familiar. I wanted to make a lot of trades. You can't make a lot of trades if you're a swing trader or trading up off the 4-hour charts. And so I traded down on the 5-minute charts, and I I enjoy that. There's plenty of people that make a shithouse full of money trading on the lower time frames. The long-term traders poop on the short-term traders. The long-term guys will say, I never saw a short-term trader that made any money. The short-term traders will look and say, I never saw a beginner trader survive trading up on the longer time frame because the risks are so much higher and your win to loss is so bad. How could you possibly win? It's like the debate that goes on between the fundamental traders and the technical. The fundamental guys, I've never seen a technical trader make any money. The technical guys say, why the fuck would you be a fundamental trader? You can't keep up with the big hedge funds and stuff, and the fundamentals don't take effect until over periods of days, if not weeks. I'm in trades for 15 minutes. What do I care? So you get all these debates. It isn't worth debating, and it's not worth worrying about. Every successful major trader will say, I trade according to my personality and build the system that works for that personality. Okay? They all say that. So somebody that's down on the 5-second chart has, with a good system, has just as profitable experience and makes just as much money as the guy that's trading up on the daily charts. There are day traders that are making hundreds and hundreds of thousands of dollars a year, and there's long-term traders that are making hundreds and hundreds of thousands of dollars a year. It isn't the time frame or all that's the concern. What are the rules that you have to keep you out of trouble? Risk management is the whole thing. So whether you're a long-term trader off of the daily, or whether you're a scalper down on the 1 minute and 5 second chart, doesn't make any difference, is you have to have good risk management. So if you're down on the 5 second chart, you can't have a, I mean, a 5 second chart might have an ATR of a pip and a half, right? So you can't have a 3 pip stop proportional to where I'm at, like on the 5 minute chart with a 5 period ATR. My stop is 8 pips. You can't do that percent and a half. I've gone over this before. It doesn't work proportionally because the noise and the chatter changes the mathematics. And you really have to understand mathematics and Fourier transforms and all this other shit in order to visualize what's going on in this random soup that we call the market. That doesn't mean that it complicates things, but if you have a physics and a math background, which is very complicated, you can take that and abstract out all of the noise from what's going on in the market and say, this is what's causing that noise, or this is the result of the activity behind the noise. And you can trade successfully with it. And you don't need a math and physics background in order to be able to do that. You need experience. That's what Jesse Livermore says. Invest your cash, track your results, and learn from your mistakes. Can't be any fucking easier than that. I think the reason a lot of people fail in trading is either they miss something, you know, like I did when I lost my large account, when I first started trading a large live account. I listened to all these people on YouTube, and I read hundreds of books and watched hundreds and hundreds of videos, and tried to replicate what they were doing as best practices. Best practices. You know, trade on the daily and do this and do that and do that. Well, you know, look, if you're trying to trade a $2 million account, you're not scalping for 3 pips. I mean, the fact that you put 200 lots into the order probably isn't going to affect that price more than maybe 2 or 3 pips. But that 2 or 3 pip slide plus the VIG that you pay on the spread, you're just going to chew yourself up trying to trade for 3 or 4 or 5 pips. You see Greg Secker do that with, he's got a $2 million account, and he makes 10 pips. He makes $20,000 in 5 minutes. Well, you know, that's great. He has one particular setup that he looks for, and when the momentum goes up, he goes all in. It moves the price for him, but then everybody else gets in, and because that's the direction that the order flow, that the commerce behind the currency markets is moving, and he has a way to judge that he can go in with a $2 million order. It goes up 10 points and he makes $20,000. If you're trading a mini lot and it goes up 10 points and you make 10 bucks, what are you going to do with that? It's a fucking pizza, right? I've said that so many times. And that's where we get jammed up, I think, as retail traders, is we don't really have respect for the pips. And I've done videos on you need to respect the value of a pip. And you respect the value of that pip by having good risk management. You have to have good risk management, because if you don't, you're not going to end up with enough money to be able to invest when you finally figure things out. You have to lose in order to learn. You don't learn when you win. All you do is build your ego and think you're a fucking master of the universe. You have to lose. What would make you change your mind about something if every time you won, you'd think you had the process right? And that was my failure in this particular trade that I'm in right now, is that I had been right so many times, but not wrong enough times to learn from it. And I'm not really sure that I would have, without Langer's help, to say, I wouldn't have made that fucking trade. What's the matter with you? You know, and then I go, well, I don't know what's the matter with you. Why did I make the trade? What is it because I've been studying this stuff since 2007. It's 2021 right now. Now, I had a 40-year career in real estate, trading. I understand this stuff. Now, Langer's has been trading currencies for 20 years. I've only been trading a real live account, a big one, since 2017. And so I don't have the actual in the trenches hardcore view that somebody with 20 years of trading. And he just says, I wouldn't take the fucking trade because that's against his rules. So I got to look at my personality and go into the thing and find out where I went wrong. And I think I figured it out. I mean, I'm just figuring this stuff out now. That's why this is a collaborative video with you folks. And, you know, if you're looking at this thing in 2024, you know, you can fast forward to the videos I'm doing in 2024, or if I drop dead or something and I'm not there anymore, there'll be tracks of my evidence of whether I became successful or I didn't. But we all have to do this on our own investigative process. But regardless of all that, because you can come up with all kinds of stupid shit, it has to be based on some facts. So while you're learning, you have to have very, very rigorous risk management. The stops can't be long because you're going to lose so many more times than you're going to win as a beginner. You just are. So don't lose 30 pips 6 times and win 20 pips 4 times. It's not going to, and you're not going to win 20 pips as a beginner. You either win 5 or 8 or I don't know what you're going to win. It isn't going to work out because I've done the computer simulations on it. It doesn't work. You need a win-to-loss ratio of at least 60% before you start trading big money. And even then, you're marginal. 60%, you only got a 10% edge. You know, you're fighting the VIG, the spread, you're fighting the volatility, you're fighting the underlying news that's running this thing. 60% is nothing. You get it wrong 4 or 5 times in a row with a 60% win to loss, and you're screwed. And as a beginner, you don't have a good grip on your emotional self, and so you'll do stupid shit. You know, I've got a little, as I said many times, up here on my left shoulder. I don't know whether you can see him or not, but I have a little bridge troll. His name's Ed, and he sits up on my left shoulder, and he tells me to do stupid shit. And if I turn my head and listen to Ed and do that stupid shit, it costs me money. Every time it costs me money. But I lose money when my stop gets hit. And I have a short stop. So while I was learning to trade, getting things squared away, I lost many, many times because I didn't know what I was doing, and that price just spun around and took me out. So you only have a 30% win rate when you're learning, or 40% win rate, and you get, in my example, I'm trading 5 minute. I got a 5 minute, 5 period ATR and a 5 pip ATR, and my stop is at 8 pips. So if I don't get my trade entry right, which you don't as a beginner until you figure things out, you end up getting that 8 pip stop hit many times. Look, I can get that 8 pip stop hit 3 times for a net loss of 24 pips and still not, and learn a lot. Whereas if I let that run to a 30 pip or a 24 pip, you know, a 24 pip stop, you're giving the thing room to breathe. This is my opinion. Again, not what you should be doing as a beginner. Listen to what folks that know what they're doing for beginners on this stuff that Langer's is, and you put that stop down because you don't know enough when you go into the trade. You got to let that price breathe, you know. And so if you set that stop out 30 pips, and you're trading on a 5 minute or whatever, the reactions are going to be 10, 15 pips, maybe 20 pips. But then it'll turn around, and it'll go in your direction because it's not stupid. You're not jump ball entering trades. You're not going, oh, that looks pretty good. I think I'll go take that trade. No. You look at the thing. You have some rules. You know, you read some books or something, and they give you some guidelines as to when it's good to go in and take a trade. The beginning rule is, if I'm teaching somebody who's a beginner, if the daily chart is up, don't fucking trade down, no matter what time frame you're on. That keeps you out of the shit most of the time. God. But if your personality is such that you want to be a day trader and even scalping, that's fine. But you need to learn how to trade in the correct manner first, with the idea that maybe counter trading and bringing your stop up short might be more in line with your personality. So when you get to that point, when you're looking at bringing that stop up, again, we're talking about risk management and how you would then go into trading counter to the long-term trend. You have to have that short stop, because if you're wrong, you got to figure that out right away before that fucker spikes on you 200 pips, or before the little bridge troll Ed starts going, it'll come back, and you believe him, and it goes 200 pips against you. Well, look, if you're trading a 10 lot, you're trading $100 a pip. That's a lot of fucking pips. It's a lot of money. You don't want to do that. You don't want to get stuck with that. You don't want to trade along being successful and working your way out of jams so that you think you know how to trade. Trading should be simple. You put the trade on, it goes in your direction, and you pick off your profits, close up shop, and go watch a movie. That's trading. That's the way the trading is. If you're wrong, find out right away, pick up your marbles, go watch a movie. But it takes experience to get to that point. So what I'm saying is, when you get to that point, you have a decision to make. Do you want to short stop? And would you consider trading against the trend when you're looking at a trend on that, for example, on that 15-minute that's counter to the daily? Would you make a counter trade to that? Now, I'm in that investigative process. I'm not saying, this is what I'm going to do. I'm telling you that this is what I've done, but I didn't know all the rules. I didn't have all the rules for it, and I got caught. I got caught in this maybe, I get caught about every 3 months. That's what happens to me. That's how often I get caught. And when I get caught, it's usually 15 or 20% of my account that goes. All right, now that's a lot, but if you're right and you're doing well and doing 10 or 15% a month, then you lose a month out of the 2 or 3. It's a huge hit. But it's not catastrophic, because at the end of the year you end up with a reasonable 20% on your money gain, or whatever is reasonable for you. I mean, some people make 300% a year. Who can say whether you're going to have the magic or not? And also, all of my advice goes out the wall if you're stupid enough to be out there trading at 500 to 1 leverage, or even 100 to 1 leverage. That's just not, don't even watch my videos if you're doing that. That's just stupid. Or if you're over leveraged yourself, You know, you got a one lot, and you're going to trade two against it because the spread and the margin requirement puts you right at the borderline of that, and you're just hoping that you'll have enough juice in the price to trade two lots against the one and make double the money, and it goes against you. I mean, you just can't. If you do that kind of thing, you're wasting your time watching my video. You're wasting your time watching everything. Go to a tarot card reader and learn how to trade, but don't waste your time watching this stuff. Regardless of whether you're a beginner or you're a day trader, it's the risk management that takes precedence over every other fucking thing that you do. And so if I take a short 8-pip stop on my 5-minute time frame chart with a 5-period ATR, 5-pip ATR, and I get hit 3 times, that's the equivalent of letting price breathe so that it goes down 24 pips and hits my panic stop. The difference I feel personally is that I'm going to learn a hell of a lot more by losing 3 times than I will by losing once. Because if I lose once, I just go, well, that didn't work out. That didn't work out. But if I lose 3 times against that short stop, I'm going to say, wait a minute. I must not understand trade entry the right way. And all this bullshit about stop hunting and all this crap goes right out the door when you're short stopped. Stop hunters don't short stop. Stop hunters, big institutional traders, are going to go for the guys that are 20 pips out. Because 20 pips to them, they can accumulate an enormous amount of inventory, spin it around and go the other direction, and then you're sitting there looking at a fucking pin bar going, whoa, what happened there? I want to learn. As traders, we should be learning every day. If I have that short stop and I'm getting hit 4 or 5 times during a trading period, I don't have anybody to blame but myself. And the only thing that I have to look at is the trade entry part, not the fact that the stop is short. It's why is it getting hit? The stop isn't getting hit because it's short. The stop is getting hit because I have bad trade entry process. Fix it. So now, based on what I've seen in this thing, I can see what I do wrong that causes me 20% drawdowns. I know how to fix that. Now I have to do that enough times so that I can come back to you and say, yeah, that worked, or no, I had to tweak that idea a little bit, or no, the whole thing, you're eventually going to get caught, and it's not viable to think that way. Let's all just go, regardless of your patience and your personality to short-term trading. You may very well have to wait for those trades. If the daily chart has got an uptrend, a strong uptrend to it, you better just trade on the long side, because that's easy. It's easy as a beginner, and it's right as a beginner, and it's most likely, I'd say, 80 or 90% valid for an experienced trader. The trouble the experienced trader, such as myself, has with that is that my personality just doesn't match that rule. I may have to change the way that I think, but I'm going to invest my cash, and I'm going to track my results, and I'm going to learn from my mistakes, and I'm going to learn whether I can fix that or not fix it. Now, the fact that I will or will not be able to fix that is immaterial to you. What you need to consider is, what are you going to do? And did you know that this potential trading paradigm or issue exists. Number one, would you counter trade? And if you do you have all of the moving parts that you can look at, the mechanics of it that you can look at to determine what could go wrong so that you can implement risk management to mitigate that? Or is there such a rule? That's where I'm at right now in my particular thing that I'm working on. I have enough confidence in it that I'm willing to risk my cash trading full lots. So I'll have to get back to you on that. In the meantime, wondering about taking the dog out because the nor'easter's coming. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.